Thank you very much. I'm really excited to be part of this conference, which seems to me absolutely the right topic at the right time. We should be thinking about what's happening to us currently, and it is momentous. But much more important, I'm glad to see Stanford and all of you thinking about how do we prepare ourselves for a better economy in the future? What's it going to be like? Not that anybody's ever been very good at predicting things like that, but if we don't think about it, we're in trouble. We're in the middle, as everybody knows, in the middle or in the midst or somewhere, of a very deep recession, which is definitely not over yet, and was precipitated by a catastrophic meltdown in the financial sector. Of really epic proportions. We haven't seen, there are few people in this room that could remember the 30s, but none of us were actually adults in the 30s, I don't think. We haven't seen anything like this since then. So my job is to talk for the near term and what might be done to improve it, and then set the stage a little bit for talking about jobs of the future. The current outlook is just extraordinarily uncertain. Economic forecasting is not a very certain thing ever, but it's hard to think of a time when we had less surety that forecasts based on past experience were likely to be right. And the only thing you can base forecasts on is past experience. Now, we got a lot of models, and the models all say roughly the same thing, namely that it's likely that the rapid fall in the GDP will bottom out by the end of this year or early next. But what we know about unemployment is that it will continue to rise, because that always happens in recessions. It will continue to rise well beyond the bottom of the recession, and we don't know how far. But if you look at the current forecast, people say, okay, bottoming out early in 2010, peak unemployment probably summer or fall of 2010 at something like 10% or something like that. That sounds like we might survive, and we will. But I wouldn't put a lot of faith in those numbers. Just, think about what they're based on. They're based on the experience since World War II, which means a model is telling you roughly what does our experience tell us will happen in circumstances like this if our banking and financial system is functioning well. And it's not, and we know that. So the model isn't telling you very much, and what we don't know is how the outlook will be affected by the rescue of the financial sector, assuming that it works fairly quickly. If you sort recessions around the world over several decades into two piles, and look at the ones that were precipitated by financial crisis and the ones that weren't. The ones that were precipitated by financial crisis are deeper and longer, and sometimes quite catastrophic. So there is reason to be cautious on the downside about any model forecast at the moment. I think the other reason, and the main reason I think we may climb slowly out of this recession in terms of getting back to anything like full employment, is that we really don't want to get back to the economy that we had before the recession, where we had high consumer spending out of income, zero household saving. We were borrowing a lot of money from around the world. We were on an unsustainable track. We need to get back to an economy where incomes are growing, consumption is growing as well, but is not consuming all of income, so that we are generating positive domestic saving to finance a share, and an increasing share of our domestic investment. And that sounds good, but it's not good if you're in retail or you're in some consumer service, because it means that those consumer-based industries, including housing, are likely to come back slower than we might have thought, looking at the history of the last several recessions. But I think that all sounds kind of gloomy. What does it mean quantitatively? We don't really know, but probably we won't get back to what we'd like to think of as full employment for quite a number of years. Now, whatever that means, I don't know. You know, maybe 3, maybe 5, but it's not going to be a quick picture. There are some reasons for optimism. I think one, which I'll get to in a minute, is that our government is doing everything it can think of, our government and our central bank, to turn things around, and it's likely to make things better, I think, than not doing it, but we don't know exactly how well it will work. The other basic reason for optimism that nobody needs to tell anybody in the Silicon Valley is that we are a very resilient economy. We have gotten through a lot of shocks before, and we are creative. We do new things. This is an opportunity to do it, and we have very flexible labor markets, which is one of the reasons people lose their jobs so fast and don't get them back so quickly. But that's a benefit when you're in this situation. And it's a lot better at this moment to be the United States than to be Europe, for example, not for the usual reasons. People say, oh, we don't want to be Europe because their taxes are too high. We don't want to be Europe because their labor markets are too inflexible. And we are much, their labor markets are too inflexible. Their capital markets aren't very well developed and flexible. So we're a lot better in this situation to be us.